Hello, my name is Mayanka. I am accounts and finance trainer from Uplatz. Today, in this class, we will discuss section 45. Section 45 of Income Tax Act. This is the charging section. This is the charging section. In this class, we will discuss about the taxability of capital gain. Means when the capital gain will be arise and in which year it will be taxable. When the capital gain will be arise and when we will taxable the amount of gain which is arise on the sale of any capital assets. Is that when there is any profit or there is any gain which is arise on the transfer of any capital assets, on the transfer of any capital assets, then such gain or such profit will be taxable under the head of capital gain, and it will be taxable in the year when the transfer taken place, when the transfer taken place. So, for the purpose of this, we have already covered the definition of transfer and the definition of capital assets in our previous class. In our in our class 1 or in our class 2, we have discussed the meaning and the definition of capital assets and the meaning and the definition of transfer. So now we will start about the taxability of such profit and gain. Section 45 of Income Tax Act, charging section of capital gain. Now we will start our class. First, we will discuss scope and the year of chargeability. Means the scope and the year in which the capital gain will be charged for income tax. Means when the income tax will be levied or when we will calculate the amount of income tax on such amount of gain or on such amount of profit. Scope and year for chargeability. Section 45. General provision. First, we will discuss general provision. General provision about the chargeability, about the scope and the period of chargeability. Section 45, subsection 1. Section 45, subsection 1. According to the general provision, when there is any profit and gain, when there is any profit or gain which is arise on the transfer of any capital assets, when there is any profit, when there is any profit which is arise on the transfer of any capital assets, when there is any profit or there is any gain which is arise on the transfer of any capital assets, then such profit or gain will be taxable in the year in which the transfer taken place. Then such a profit or such a gain will be taxable in the year in which the transfer taken place. Is that any profit or gain arising from the transfer of a capital assets effected in the previous year shall be chargeable to tax. It shall be chargeable to tax under income tax under the head of capital gain in the previous year in which transfer took place. In the previous year in which transfer taken place. When the transfer taken place, such a gain or such profit will be taxable. Such a gain or such profit will be taxable. For the example, there is a person, Mr. A. He transferred he transferred his plant and machinery to B. He transferred his plant and machinery to Mr. B. And in this case, the sale consideration means the sale price. The sale price is, for the example, 1,50,000 and he purchased it on cost of acquisition. The cost of acquisition, for the example, it is 1 lakh rupees. It is 1 lakh rupees. So the amount of profit on the sale of such a capital assets, on the sale of such plant and machinery is 50,000 rupees. It will be considered as capital gain. And such capital gain will be taxable, and such capital gain will be taxable in the year in which the transfer taken place. For the example, transfer taken place in 2019 and 20, then such a capital gain will be taxable. In the previous year, 2019 and 2020, under the head, sorry, capital gain. Such amount or such gain will be taxable under the head of capital gain in the previous year in which transfer taken place. So the transfer taken place in 2019-20. So such amount of capital gain, such amount of 50,000 rupees will be taxable. It will be taxable under the head of capital gain in the previous year 2019-20 because the transfer taken place on 2019-20. 2019-20. So any of the profit or any gain which is arise on the transfer of any capital asset, which is arise on the transfer of any capital assets, it shall be chargeable to income tax. It shall be chargeable to income tax in the year in which transfer taken place. In the year in which transfer taken place. So this is the basic, this is the general provision about the year of chargeability, according to the such general concept. The chargeability will be arise in the year in which transfer taken place, Now we will discuss next section, insurance receipt. Now we will discuss taxability or the year in which insurance received will be taxable. Section 45, subsection 1A. Section 45, subsection 1A. Taxability and the time of chargeability in the respect of insurance receipt, is that if there is any person receive the amount, or any asset from the insurance company, when there is any person receive any amount or receive any assets from the insurance company on the account of damage or on the account of destruction of any capital assets. If there is a damage of any capital assets and such capital asset is insured, and in the respect of such insured capital assets, Mr. Ram, he received the insurance or he received the money from the insurance company, then such money will be taxable in the year, means such amount will be taxable, means we will calculate the amount of capital gain. So such capital gain will be taxable in the year in which such money is received. It is received, means for the example, there is a assessee B and he has a building. The cost of the building or the WDV of the building, in the books is, for the example, 5 lakh rupees. Due to fire or due to fire, such building destroyed, or it is destroyed. But such a building is insured. Building, and Mr. B received from the insurance company the amount of insurance of rupees 7,50,000. Means he has received the amount from the insurance company, and the amount is 7,50,000 rupees in the respect of such a building. So in this situation, the amount of capital gain will be 7,50,000 minus 5 lakh. 2,50,000, it will be considered as capital gain. It will be considered as capital gain, and it will be taxable in the year when it is received. In the year in which it is received. For the example, the fire occurred in 2018. The fire occurred in 2018-19, and the payment, so 7,50,000 is received in 2019-20. Then such 2,50,000 will be taxable in the year when such payment received, means it will be taxable in the previous year 2019-20 when such amount is received. When such amount is received, the amount is received in financial year or the previous year 2019-20, then such capital gain will be taxable in the previous year in which the amount is received. The amount is received. Normal provision is that the capital gain will be taxable in the year in which transfer took place, but in the case of the insurance receipt, the capital gain will be taxable in the year in which the claim received. Is that where any person receive any money, when any person receive any money or any assets from the insurance company on the account of damage or destruction of any capital assets, as the result of, means such assets destroyed, such assets destructive due to the flood, due to the typhoon, due to the hurricane, due to the cyclone, due to earthquake or any other consumable of nature, or remote or civil disturbance, or accidental fire or explosion, or if there is any action which is taken by the enemy, or action taken in combating an enemy, with or without the declaration, then there is any profit or there is any gain which is arising from the receipt of such money or from the receipt of such capital assets, then it shall be chargeable to tax under the head of capital gain, and it shall be considered as income in the year in the previous year in which the money or the other asset was received, means it will be considered as income in the hands of such a recipient in the year in which the money or the other asset was received. Is that if, for the example, the fire is occurred or the earthquake is occurred, and due to the earthquake the building damaged, the building destruction, there is a destruction of building, and but such building is insured by the company, and the company received the amount, received the insurance from the insurance company, so we will calculate the amount of capital gain. Means we will calculate the amount of profit or gain which is arising from such a receipt, and if there is any gain or there is any profit, then it will be taxable under the head of capital gain in the year in which such payment is received, the payment was received or the asset was received. Next, full value of consideration. What will be the full value of consideration? In the respect of this, what will be the full value of consideration? So, to compute the full value of consideration, so when, as per the provision of capital gain, when there is any amount or when there is any capital assets is received in the consideration, then in the case of capital assets, how we will determine the full value of consideration? So the fair market value of such assets. The fair market value of such assets on the date of such receipt shall be deemed full value of consideration received or equity as a result of transfer of such capital assets. Is that if for the example, there is a capital asset or the other asset is received by the person, from the transfer of any assets, for the transfer of any asset, or there is any other asset is received from the insurance company, from the insurance company. So what will be the value of such assets? So the fair market value of such assets we will consider as the full value of consideration. We will consider the full value of consideration. Now we will discuss it by the way of example. Just like Mr. C, he transferred his house property to Mr. D, and and Mr. D provide his plant and machinery to Mr. C, to Mr. C. So in this situation, the what will be the full value of consideration? What will be the value of consideration? What will be the value of consideration? Because there is no money, there is the plant and machinery which is provided by Mr. D to Mr. C. So the value of consideration will be fair market value of such a plant and machinery. Means to calculate the amount of capital gain. Mr. C will determine the value of plant and machinery. So the fair market value of such plant and machinery will be considered the full value of consideration. The fair market value of such plant and machinery will be considered the full value of consideration. So when there is any transfer taken place, and in the consideration of such transfer, any other assets other than money, any other asset is provided in the consideration. So the fair market value of such assets will be considered as full value of consideration. Is that, for the example, the value of plant and machinery, the fair market value means the fair market value of plant and machinery, for the example, is 2,50,000. It will be considered as full value of consideration. So the full value of consideration is 2,50,000 less cost of acquisition. For the example, the cost of acquisition of such a house property, because he is transferring the house property. House property is 2,25,000. So in this case, the amount of capital gain, the capital gain is 25,000. The amount of capital gain is 25,000 rupees, and it will be taxable. And it will be taxable as per the normal provision, means in which the transfer taken place. So the FMB of the other assets, if there is any other asset which is received on the transfer of any capital assets, then the fair market value of such assets will be considered the full value of consideration. Now we will discuss the treatment or the conversion of any capital assets as stock and trade. Is that when there is any conversion of capital assets into the stock and trade, then it will be considered as transfer. As per the definition of transfer, when there is any person, he has converted his capital assets into the stock and trade, then it will also be considered as transfer. Then it will also be considered as a transfer. So in this situation, in the case of such a transfer, where taxability will be arise, means when we will calculate the amount of capital gain, and we will taxable such amount of capital gain. When we will calculate and when we will taxable such amount of capital gain, is that if there is any person who is the owner of any capital asset, and he convert and he convert such capital assets into the stock and trade, then it will be considered as transfer. It will be considered as transfer as per the definition of transfer. As per the definition of transfer is that, for the example, Mr. D, he is he has a house property. He has a house property as a capital assets. As a capital assets. Now he engage in the business of real estate. Means now he will sell and purchase buildings and properties. Now he will sell and purchase the property. He converted his house property into stock. Means he will also sell it. Means he converted it into the stock. He converted his house property into the stock. Then it will also be considered as a transfer. It will be considered as a transfer. According to the definition of transfer, according to the definition of section 2, subsection 47, according to the section 2, subsection 47, it will be considered as transfer. It will be considered as transfer. So, as per section 45, subsection 2, notwithstanding anything contained in section 45, subsection 1, means if there is any conversion of capital assets into the stock and trade, then section 45 subsection 1 will not be applicable. Section 45 subsection 2 will be applicable, and according to this, the profit or any gain which is arise from the conversion, the profit or any gain which is arise on the conversion of such a capital assets into the stock and trade will be chargeable to income tax in the previous year in which the stock and trade sold or otherwise transferred by him. Means if there is any capital gain arise on the conversion of capital assets into the stock and trade, then such amount of capital gain will be taxable in the previous year in which the stock and trade is sold. Means in which such house property will be sold or otherwise transferred to him. Then in such period, in such previous year, such amount will be taxable under the head of capital gain. Is that for the example? For the example, we will continue this example. He converts his house property into the stock and trade. Okay, house property is considered as stock. It is not considered as capital assets. Now, he convert it in 2019-20. Okay, he convert in 2019 and 20, and at the time of in 2020 and 21 he sell such stock. He sell such stock in the year 2020 and 21. In the year 2020 and 21, he sold such stock or he has transferred such stock. So in this situation, if there is any capital gain, which is arise on the conversion, means the conversion taken place, means for the example, the value of the such capital assets was rupees, the capital 1,50,000, and where it is converted, when it is converted in stock, then it is valued at, when it is converted in stock, then it is valued at 2,50,000. Means there is the capital gain 1 lakh rupees. This is the amount of capital gain. It will be taxable in the year in which such stock was sold. Means it will be taxable in the previous year 2020 and 21. It will be taxable in the year in which such stock was sold. Such stock was sold. The stock was sold in 2020 and 21. So such capital gain will be taxable in the year in which stock sold, not in the year in which transfer taken place, or not in the year in which the conversion meet. It will be taxable in the year in which the stock sold, under the head of capital gain, under the head of capital gain. So his income of the previous year in which stock and trade is sold or otherwise transferred by him. What will be the, for the purpose of this section, for the purpose of section 45 subsection 2, what will be the value of consideration? What will be the full value of consideration? Means what is the meaning of full value of consideration? What is the meaning of full value of consideration? So to calculate the amount of capital gain, the fair market value of the assets, on the date of conversion or on the date of treatment deemed shall be deemed full value of such consideration which is received as a result of transfer of capital assets. Is there the FMB? The FMB of such assets, we will take to calculate the amount of capital gain. The fair market value of the asset on the date of conversion. On the date of conversion, we will consider to calculate the amount of capital gain. The amount of capital gain means the amount or the FMB which is available on the date of conversion will be considered as full value of consideration. It will be considered as full value of consideration. So when there is any conversion of capital assets into the stock in trade, when there is any conversion of the stock in trade when there is any conversion of capital asset into the stock and trade, then what will be the tax liability? So number one, income from capital. First, we will calculate the amount of the income which will be taxable in the or under the head of capital gain. So the capital gain will be, so first we will determine the fair market value on the date of such conversion less cost of acquisition. And we will also reduce the cost of improvement if any. Is that when we will calculate the amount of capital gain, then the capital gain will be calculated as follows. Number one, fair market value. The fair market value of the asset on the date of such conversion. Less cost of acquisition or cost of improvement. For the example, the means conversion in stock and the FMB of the stock is 2,50,000 and less the cost of acquisition of such assets. Cost of acquisition is 1,50,000. So such 1 lakh rupees will be taxable. So such 1 lakh rupees will be considered as income and it will be taxable under the head of capital gain. Indexation benefit would be considered in the relation to the year of conversion of capital assets into stock in trade. Indexation benefit would be available in the year in which the conversion taken place. Income from business will be sale price of stock in trade minus FMB as on the date of conversion. Is that, for the example, such 1 lakh rupees will be taxable under the head of capital gain. Now, stock sold. For the example, the stock sold at 3 lakh rupees. The stock is sold at 3 lakh, but the FMB of the stock is 2,50,000. The FMB of the stock is 2,50,000. So in this situation, the profit will be 50,000. It is the PGBP profit. Means such profit will be taxable under the head PGBP. Such profit will be taxable under the head of PGBP. So under the capital gain, the profit will be 1 lakh rupees, and under the PGBP, the profit will be 50,000 rupees. So this is the summary. This is the summary when there is the conversion of capital assets into the stock and trade. So what will be the income which will be taxable under the head of capital gain, and what will be the income or what will be the amount which will be taxable under the head of business, under the head of PGB. So now we will discuss a example. Now we will discuss a example, and on the basis of such example, we will understand how we will calculate, how we will calculate or how we will determine the amount of income which will be taxable under the head of PGBP and which will be taxable under the head of capital gain. So now we will start. X convert his capital assets which is acquired on 10th June 2003 for 60,000 rupees. Means Mr. X, he has a capital assets. He has a capital asset which is purchased on 1st June 2006. Na? It is, sorry, 2003. It is purchased on 10th June 2003 at rupees 60,000. At rupees 60,000. And he convert it into stock in trade on March 2020. Convert such capital assets into stock on 10th March 20. Okay. The fair market value on the date of such conversion is 5,50,000. The FMB is 5,50,000. The FMB of such value on the date of conversion is 5,50,000. He subsequently sees the stock in trade so converted by 6 lakh. And after the conversion, he sold stock at rupees 6 lakhs. At rupees 6 lakh rupees on June 20. June 2020, examine the tax implication. Now, on the basis of this, there is a requirement to calculate the tax implication. There is a requirement to calculate the tax implication. There is the cost inflation index because it is the long-term capital. Because it is a long-term. Because the asset is purchased in 2003 and convert in 2020. It is converted in 2020. So there is the such a capital asset is held for the period of more than 36 months. It is to be considered as long-term capital assets. It will be considered as long-term capital assets, and in the case of long-term capital assets, the long-term capital gain will be arise. The long-term capital gain will be arise. So first we will calculate the income taxable under capital gain, under the head of capital gain. Sale consideration. Sale consideration means FMB. FMB of such assets on the date of conversion. So it is 5,50,000 less cost of acquisition. Less cost of acquisition. So the cost of acquisition was rupees 60,000 in 2003. Indexation is required to be made. So the indexation will be 60,000 into the rate of 20 and 21 is the rate of 1920 because the conversion taken place in 2019-20 is 289 divided by cost inflation in 2003 and 4 is 109. It will be 15 sorry, 1,59,082 rupees, means the cost of acquisition will be this one. So the capital gain will be 3,90,917 rupees. 3,90,970 rupees. Is that the capital asset is converted? The capital assets is converted into the stock and trade during the previous year. The capital asset is converted into the stock and trade during the previous year, 2019-20, means assessment year 2021. So it will be considered as transfer. It will be considered as transfer, and the amount of capital gain on such a transfer will be the amount of capital gain on the transfer means conversion. On the date of conversion will be 3,90,917 rupees. 917 rupees. This is the amount of capital gain which will be taxable, in the year in which the stock is sold. So now we will discuss business income. Business income. Business income means sale price, means at the rate in which such a stock is sold. The stock is sold is 6 lakhs rupees less FMB. Sorry, we will reduce FMB of such a stock. The FMB of the stock was rupees 5,50,000. So the amount which is taxable under the business, under the PGBP, it is 50,000. It is 50,000 rupees. So when there is any capital asset is converted into the stock and trade, then it will be considered as transfer, and and if there is any profit or gain which is arise on such conversion, then it will be taxable. It will be taxable in the year. It will be taxable under the head of capital gain, and it will be taxable in the year when such stock sold by the assessee. When such stock is sold by the assessee, the stock sold in the year, the stock is sold under the in year 20 and 21. The stock is sold in the year 20 and 21. Then such capital gain will be taxable in the year 20 and 21, means previous year 21 and 22. Since the stock and trade was sold on June 10, means in 20 and 21. So for the purpose of this, the fair market value will be considered as full value of consideration, means when we will compute the full value of consideration, such a FMB. Such FMB will be considered as full value of consideration, means the FMB considered full value of consideration. FMB is 5,50,000. So FMB is considered as a full value of consideration. Less we will reduce the acquisition cost. Acquisition cost is 60,000 rupees, but there is the long-term capital assets. But this is the long-term capital assets. So in the case of long-term capital assets, the provision of indexation is applicable. The provision of indexation is applicable. The provision, according to the provision of indexation, we will determine the value of the assets. Is that the how we will determine the amount, means how we will determine the cost of acquisition. So the cost of acquisition will be cost at which it is acquired into indexed rate of the financial year in which it conversion taken place, divided by, or in which transfer taken place, divided by the year of acquisition, So the assets taken place means, so the asset purchased at 60,000 rupees and transfer taken place into 2019-20, means conversion taken place in 2019-20 into 289 indexation rate, divided by when the asset is acquired in 2030. So the indexation rate of 2003 and 4. So the amount, means the indexed cost of acquisition is 1,59,082 rupees. 1,59,082.56 rupees. So the amount which will be taxable under the head of capital gain will be 3,90,970. So hence 3,90,917 will be taxable. it will be taxable as long-term capital gain, and it will be taxable in the year in which stock sold. The stock is sold in the previous year 20 and 21. So such amount of capital gain will be taxable in the previous year 2020 and 21, is that in the relevant year 21 and 22. 21 and 22. And during the same assessment year, the business income will be taxable 50,000. Means the business income 50,000 rupees will be taxable in the same assessment year as the business profit, as the business. So on the basis of such example, we have understand what will be the taxability and how we will determine the amount of taxable which is required to be taxable in under the head of capital gain and under the head of business head when there is a conversion of any capital assets into the stock and trade, and such stock and trade is sold or transferred. So on the basis of such a example, we have understand about the taxability, when there is a conversion of capital assets into the stock and trade. Now we will discuss another. Now we will discuss another section, section 45, subsection 2A. Section 45, subsection 2A means in which year or in which period we will consider or we will calculate the amount of capital gain. Means in which year the amount of capital gain will be taxable. When there is a transfer of beneficial interest in the security. When there is a transfer of any beneficial interest, when there is a transfer of any beneficial interest in the security, then when the amount of capital gain, or in which year the amount of capital gain will be taxable, in which year the amount of capital gain will be taxable, is that if there is any person, he held the beneficial interest in the security. If there is any person, he had any beneficial interest in security, and he transferred such a security, or he transferred the benefit interest in the security to the any other person, and on the date of such a transfer, if there is any amount of profit or there is any amount of gain, if there is any profit or there is any gain which is arise from the transfer of such a beneficial interest in security, then it will be chargeable, in the year in which a transfer taken place. Means where any person, he had any time during the previous year, any beneficial interest in any security. Means he has beneficial interest in any security at any time during the previous year, and he transfers such property, and he transfers such a beneficial interest to another person. So the amount of profit, any amount of profit or any amount of gain which is arise, any amount of gain or any amount of profit which is arise from the transfer of such a security, when there is any profit or any gain which is arise on the transfer, when the transfer is made by depository or participant of such a beneficial interest in the respect of such security, then it will be chargeable to tax, in the hands of beneficiary owner, and it will be chargeable in the year in which such a transfer took place. Such a gain will be eligible for the taxability in the year in which the transfer taken place, and shall not regard as income of the depository who is deemed to be the registered owner of the security by the virtue of section 10 subsection 1 of the Depository Act 1996, is that when there is any person who has the interest in any security, if there is any person, he has the interest in any security in any of the time, means anytime, at any time during the previous year, and he transfers such a security to the any other person, and on the transfer of the security, the amount means there is the amount of gain or there is the amount of profit, then such amount of profit will be taxable, then such amount of the profit will be taxable in the hands of beneficial owner and in the previous year in which a transfer taken place, in the year in which a transfer taken place. Is that for the example, Mr. Ram, he has beneficial interest in security. He has the beneficial interest in the security. And now he sells the security or transfer. He transfer this right. Transfer the benefit of security to to any person and if there is any profit oblique gain on such a transfer, then it will be taxable. Then it will be taxable in the year in which transfer taken place. In the year in which transfer taken place. Means in the year in which transfer taken place, such amount of gain or such amount of profit will be taxable. For the example, the transfer taken place in 2020 and 21. So the amount of profit or amount of gain will be taxable in the year in which the transfer taken place. So the amount will be taxable in the year 20 to 2020 and 21. The amount will be taxable. The amount of the gain will be taxable in the year in which the transfer taken place. So the transfer is taken place 20 and 21. Then such capital gain or such amount will be taxable in the year 20 and 21. What will be the full value of consideration and the period of holding? What will be the full value of consideration in the respect of transfer of the beneficial interest in any security? Beneficial interest in any security. So, for the purpose of section 48 and provision to section 2 subsection 42A, the cost of acquisition and the period of holding of the security shall be determined on the basis of first in first out, means on the basis of FIFO method. Means the cost of acquisition and the period of holding of the security we will determine on the basis of FIFO method. Means first security, the security which come first, it will goes first. It will go first. The security which will come first, then it will go first. So on the basis of such FIFO method, we will determine the cost of acquisition and we will also determine the period of holding. On the basis of or in the case of securities, the FIFO method will be used to determine the cost of acquisition and to determine the period of holding. When the securities are transferred through the stock exchange, when there is any security which is listed in the recognized stock exchange and these securities are transferred through the recognized stock exchange, then it is the established procedure that the broker first entered into the contract for the purchase and sale of the security, then after follow it up with the delivery of share accompanied by the transfer deed duly signed by the registered holder. Is that when there is any person who make the transaction or make the transfer of the security through the recognized stock exchange. So in this case, first the broker he will enter. First the broker means such a transaction taken place on the behalf of such person by the broker, means first the broker he will enter into an agreement. First he will enter into a contract or into an agreement for the sale and purchase of security. sale and purchase of security, and then after such person will provide a delivery of such share. He will provide a delivery of such share by signing the transfer deed. Means he will sign a transfer deed that I am transferring these share to such particular person. To such particular person. So in this case, the seller means the person who is the seller is entitled to receive the consideration which is agreed on the date of contract. When the seller transfer the share, then he is eligible to take the amount or to receive the amount of consideration, the consideration which is agreed between both the party on the date of contract. On the date of contract means the amount which is determined or which is fixed between the both the party on the date of contract will be considered as consideration. It will be considered as consideration. The amount which will receive on the date of contract. Next, thus it is the date of broker's note that should be treated as the date of transfer in the case of sale transaction of security, provided such transactions are followed by the delivery of share and also the transfer deed. Is that this is the date of broker's note. It is the date of broker's note that should be treated. The date of the broker note should be treated the date of transfer in the case of the sale transaction of security, which is provided such a transaction are followed by delivery of share and also the transfer of deed on the transfer of deeds. Similarly, in the respect of purchase of security, the holding period. In the case when there is the purchase of security, so the holding period shall be reckoned. To take place directly between the party and not through stock exchange. Means if there is any purchase of security, then the holding period shall be reckoned to the take place directly between the parties, not through the stock exchange. Means in the case of purchase, the holding period will be reckoned directly between the seller and between the purchaser, not through the recognized stock exchange. So the date of contract of sale as declared by the party, and it will be treated the date of transfer. Means the sale date will be considered as the date of transfer in which the shares are transferred by the person through the sale. Means when there is a delivery of share and the transfer deed is made or transfer deed is transferred, then it will be considered as the date of transfer. And it will also consider the date of sale. In the case of security, we will use FIFO method to calculate the amount of cost. And to calculate the holding period, we will follow the FIFO method. Because, in the case of the FIFO method, the inventory which come first out, means the security which come first out, first comes and first goes, means first come first out. And on the basis of this method, we will determine the holding of the security. And we will also determine the amount, means the cost of acquisition of such security. For the example, in the case of security, we have received the security on 1st January 2020. 200 pieces, means 200 shares, and the value is 20,000. Another, on 15th 1st 2020, we have received another security, 100, at the rate of 15,000. On 25th Feb 2020, we have received another security 100 at the rate of 25,000. And on 31st March 2020, we have also received 150 shares at rupees 15,000. At rupees 15,000. And there is a transfer. There is a transfer of security. There is a transfer of security. For the example, 250. There is a transfer of 250 security. So in this case, first we will take 15 January 20. These 200 security at the rate of 20,000. And the holding period from if the transfer is taken place on 31st March 20. So from 15 January 20 to 31st March 20. Okay. The next is we have transferred 250. We have transferred 250. 250 shares. 50 shares we will taken from another lot, which is a 25 February 2020. 50. And the amount will be 7,500. The amount will be 7,500. So the value, so the total shares will be 250. And the cost of acquisition will be 27,500. And in the case of this, the period will be 25/02/20 to 31st March 2020. So this is the holding period. This is the holding period. This is the cost of acquisition, and this is the number of shares, means number of security. Number of security which is held by the assessee. Number of the security which is held by the assessee. So on the basis of this, we will determine on the basis of FIFO method, we will determine the period of holding and the cost of acquisition in the respect of security. So in other words, when there is any asset which is acquired last, then it will be in your stock. If these shares which are purchased in last, then it will be in your stock. It will be, sorry, it is 1st January. 01/01/20, and the next is 15/01/20. 100. Okay. So in other words, when there is any asset which is acquired in the last, means in the last, these are the assets which are acquired in the last. So it will always be in your stock, because another FIFO method, first come first out, means the asset which comes first, it will be sold first. It will be sold first. So normally in this situation, the long term may be less. The long term may be less, and the provision of the indexation will be applicable, but it is applicable when there is the long term capital assets. In other words, the asset which is acquired last will be taken to be remaining with the assessee, with the assets which is acquired first will be treated to be sold. So the indexation, whenever applicable for the long term capital assets, will be regulated on the basis of holding period, means it will be calculated on the basis of holding period. For the example, just like we have purchased on 20, or say we have a purchase, for the example, it is in 2010, and it is also in 2010, and we are selling it in 2020. We are selling it in 2020. So in this case, there is the long-term capital asset. It will be considered as a long-term capital assets, and the amount which will be, and the amount of any profit or any gain which is arise from the such assets will be eligible as a long-term capital gain, and the provision of indexation apply on such amount. the profit of the provision of indexation will be applied. Now we will discuss the meaning of certain terms. Now we will discuss the meaning of certain and the important terms which are related to such concept. Meaning of certain terms. Number one, who is the beneficial owner? Who is the beneficial owner? The beneficial owner means the person whose name is recorded. The beneficial owner means the person whose name is recorded as such a depository. Means as such with the depository means the person whose name is recorded in the register as such with the depository, then such person will be known as beneficiary owner. So what is the meaning of depository? What is the meaning of depository? As per the Companies Act 1956, a company which is formed or registered, if there is any company which is registered or which is formed under the Companies Act 1956 and which has been granted a certificate of regulation under section 12(1)(a) of the SEBI. Depository means when there is any company which is registered or which is formed under the Companies Act 1956 and which has been granted a certificate of registration under section 12 subsection 1A of the SEBI, then such a company will be known as depository. Then such company will be known as depository. What is the meaning of security? Security means any security. Security means any security which is specified by SEBI. Means the SEBI specified anything just like a security means as a security, then it will be considered as security. It will be considered as security. So this is the some important terms. These are the some important terms. Now we will start introduction of capital assets as capital contribution. Now we will start our discussion on the introduction of capital assets as capital contribution. Capital assets as capital contribution. When there is any person who has transferred any capital assets, when there is any person he has transferred any capital assets to a firm, to a AOP and BOI, means when there is any person he has transferred any capital assets to a firm, to a AOP and BOI as a capital contribution. Is that, for the example, Mr. Ram, he wants to be the partner in a firm. He wants to be a partner in a firm, and to enter in this firm, to enter in this partnership firm, there is a requirement of capital contribution. To become the partner of such an organization or to become the partner of such firm, there is a requirement to contribute the amount of capital. Mr. Ram, he contribute the amount of capital by the way of a security. By the way of a property, means he transfer the property to such firm to become the partner of such a partnership firm. So in this case, if there is any profit or there is any gain which is arise from the transfer of such capital assets, then it will be taxable in the year in which the transfer taken place. Means such a capital gain or such profit will be taxable in the year in which a transfer taken place. Is that, for the example, Mr. Ram, he wants to be the member or the partner of a ABC partnership firm, He wants to be the partner of a partnership firm. For or to become a partner, there is a requirement of capital contribution. There is a requirement of capital contribution of rupees 2,50,000. There is a requirement to contribute the amount of capital, and the capital contribution is 2,50,000 rupees. Capital contribution is 2,50,000 rupees. He transfer capital assets to such a firm as capital contribution. he transfer our capital assets. He transfer our capital assets to such a firm. To such a firm as the capital contribution. For the example, the FMB or the cost, yeah, WDB, or say the WDB of such a property or of such assets is a 2 lakh rupees. Of such 2 lakh rupees. So in this case, the amount of profit is 50,000. The amount of profit is 50,000, and it will be considered means a contribution. The contribution which is done by the Mr. Ram in a firm will be considered as transfer. It will be considered as a transfer, and if there is any profit or there is any gain which is arise on the transfer of any capital asset, then it will be taxable in the year in which a transfer taken place. Taken in which the transfer taken place, and it will be taxable under the head of capital gain. So, in this situation, such 50,000 rupees will be taxable in the year in which such a transfer taken place. Means in which year the contribution is required to be done, or the person transfer such property to such partnership firm. For the example, he transfers such property to the partnership firm in 2019 and 2020. Then such amount of profit means 50,000 rupees will be taxable in 20 and 20 2019 and 20, means it will be taxable in the previous year 2019 and 20. Such 50,000 rupees will be taxable. Such 50,000 rupees will be taxable in the year in which transfer taken place. The transfer taken place is in it is taken place in 2019 and 2020. 2019 and 2020. So when there is any person transfer a capital asset to the partnership firm, when there is any person transfer any capital asset to the firm, to a AOP and a BOI, in which he is already a member or the member, or he wants to be the means become the partner or become the member of such a AOP, BOI or the firm, and such a transfer is made by the way of capital contribution, means he transfers such assets as a capital contribution. Then then the profit which is arise then the profit which will be arise on the transfer of such capital assets, it will be taxable in the year in which transfer taken place. Is that if there is a person which transfer a capital asset to the firm, to the AOP or the BOI, in which he is already a partner or he is already a member, or he wants to be the partner or member, and for the purpose of this he transfer any capital asset as a capital contribution, then the profit or the gain, then the amount of profit and gain which is arise then the amount of profit and gain which is arise from the transfer of such assets, from the transfer of such capital assets, will be taxable. It will be taxable as the amount of profit or gain in the year. Such amount will be taxable in the year when the transfer taken place. Such profit or gain will be taxable in the year in which a transfer taken place. So the transfer is taken place as per the example is in 2000 2019 and 20. So such amount, so the 50,000 rupees, the amount of gain or the amount of profit will be taxable in the year 2019 and 20. So what will be the full value of consideration? What will be the full value of consideration for this purpose? The full value of consideration will be deemed to be the amount which is recorded in the books of account of the firm of the AOP and BOI as the value of capital assets. Means there is a requirement to provide capital contribution 2,50,000. So such assets will be registered. So such assets will be entered in the books of account as 2,50,000 as a capital contribution. Then the FMB will be, or the full value of consideration will be 2,50,000 rupees. It will be 2,50,000 rupees. Means the full value of consideration will be deemed to be the amount which is recorded in the books of such firm. in the books of such AOP and BOI as the value of the capital assets, as the value of the capital assets. Now, next, in the next case, what will be the means when the amount of capital gain will be taxable? When the amount of capital gain will be taxable? Distribution of capital assets on the dissolution of firm AOP and BOI means when there is a dissolution of the partnership firm and there is a dissolution of AOP and the BOI, and at the time of dissolution there is the distribution of capital assets, there is the distribution of capital assets, then such a distribution will be considered as transfer. Then such a distribution of the capital assets will be considered as transfer, and any profit or any gain which is arise, it will be taxable under the head of capital gain. It will be taxable under the head of capital gain. Is that when there is any profit or there is any gain which is arising from the transfer of capital assets by the way of distribution of capital assets on the dissolution of firm or AOP or BOI. When there is any profit or there is any gain which is arising from the transfer of capital assets, which is arising from the transfer of capital assets by the way of acquisition, sorry, by the way of distribution of assets. Distribution of assets. As such a distribution of the asset is made on the dissolution of the firm, dissolution of AOP and BOI or otherwise, then such amount of profit, then such amount of gain will be taxable in the year in which transfer taken place. Means such amount of profit or such amount of gain will be taxable in the year in which such a transfer taken place. In which such a transfer taken place. Now we will discuss it by the way of example. Just like there is a partnership firm. There is a partnership firm. Okay, and in such partnership firm there are two partners, sorry, A and B, and such firm has some capital assets. It has some capital assets. On the liquidation, or dissolution, on the dissolution of such a partnership, on the dissolution of such a partnership firm, the capital assets are distributed between A and B. The capital assets are distributed between A and B. Between A and B. It will be distributed between the A and B. So if there is any profit and gain arise on such a distribution will be taxable in the year in which transfer taken place. In which the year transfer taken place. Is that how we will calculate the amount of assets? How we will calculate the amount of capital gain? So, for the example, the FMB of such capital assets, for the example, is 5 lakh. FMB of the value is 5 lakh rupees, and sale consideration means consideration received. The FMB of the share is 5 lakh rupees. For the example, it is 5 lakh rupees. And if there is any profit, the profit arise. For the example, the FMB of the capital asset is 5 lakh and less cost of acquisition. Cost of acquisition. The cost of acquisition of such assets, for the example, 4,50,000. So in this situation, such 50,000 shall be taxable as capital gain under the head of capital gain, and it will be taxable in the year when the transfer taken place. When the transfer taken place. For the example, the liquidation and the dissolution is taken place, and the company or the partnership firm distribute these assets between A and B in the previous year 20 and 21. So such amount will be taxable in the year 20 and in the previous year 1920. It will be taxable in the previous year 1920 because the transfer taken place in the previous year 2019-20. So when there is any profit or there is any gain which is arise from the transfer of any capital assets, which is arise from the transfer of any capital assets by the way of distribution, by the way of distribution of any capital assets, the distribution which is made, the distribution which is made by the which is made the distribution which is made on the dissolution of partnership firm, on the dissolution of AOP and BOI, or otherwise, then such amount of profit or then such amount of gain will be taxable under the head of capital gain in the year in which a transfer taken place. In the year in which the transfer taken place. So what will be the full value of consideration? For the purpose of this, what will be considered as full value of consideration? So for the purpose of this, the fair market value. For the purpose of this, the fair market value of the assets. The fair market value of the assets on the date of such transfer shall be considered as FMB. Means the fair market value, the full value of consideration means the FMB of such assets will be considered the full value of consideration on the date of such transfer. Means on the date of such transfer, the value, the FMB of such a asset is 5 lakh rupees. Then the full value of consideration will be 5 lakh. Means it will be considered. So the full value of consideration is equal to fair market value of such assets. Fair market value of such assets. There is a case. Now we will discuss a case, because the case laws are very much important to understand, because on the basis of this the taxability will be changed. It may be changed. The Bombay High Court made a landmark judgment. The Bombay High Court made a landmark judgment in Commissioner of Income Tax versus A.N. Naik Associate 2004. 136 Taxman 107. The court applied the mischief rule about the interpretation of statute and point out that the idea behind the introduction of subsection 4 of section 45 was to plug it a loopholes and block the escape route through the medium of the firm. The High Court observed that the expression otherwise has not been read induced generic. Means the High Court observed that the expression otherwise, there is the otherwise, distribution of capital assets on the dissolution of firm, dissolution of AOP and dissolution of POI, or otherwise. So the High Court explained that the word otherwise has not been read. It has not been read in justum generic with the expression of dissolution of firm, dissolution of any body corporate, dissolution of any AOP and dissolution of any BOI. The expression otherwise has to be read with the word transfer of capital asset by the way of distribution of capital assets. Means the word otherwise is required to be read with the word transfer of capital asset by the way of distribution of capital assets. If so read, it becomes clear that even when the firm into the existence and there is a transfer of capital assets, then it comes within the expression otherwise. Since the object of the amendment was to remove the loopholes which exist, hereby capital gain shall not be charged. capital gain shall not be chargeable. Therefore, the word otherwise takes into its sweep not only the case of dissolution but also the case of substituting partner of the partnership, transferring assets in the favor of retiring partner. In the favor of retiring partner is that as per the judgment, the word expression is required to be read with the word of transfer of capital asset by the way of distribution of capital asset, not with dissolution of firm, dissolution of body corporate, or dissolution of AOP and BOI. So, on the basis of such case, the High Court express his meaning or express his explanation about the use of the word otherwise. Means how we will use the word otherwise. So there is a note that since when there is any tax treatment which is done in the accordance with LLP or under the general partnership is the same. Normally the tax treatment which is made by the LLP or by the normal partnership firm is the same. The conversion from the general partnership to the LLP will have no tax implication if the right and the obligation of the partner remain the same. Is that if there is any change, means the partnership firm now it is converted into the LLP, and the obligation and the rights and the obligation of the partners are remain same after the conversion. If there is a everything is same, means the rights of the partner are same, and the obligation of the partner are same, there is any no change, then it will not be considered as a transfer. Then it will not be considered as a transfer. But if there is any change in rights, there is any change in obligation, or there is any transfer of any assets, or there is any transfer of any assets or transfer of any liability after the conversion, then the provision of section 45 will be applicable. Means the charging section will be applicable, and we will determine the amount of capital gain, and such amount will be taken, such amount will be taxable under the head of capital gain. Is that, for the example, there is a partnership firm. There is a partnership firm. The partnership firm is Ram and Associate, or the Ram and Company. There is a partnership firm Ram and Company in which Ram and Shyam. There are two partners. Now, such a Ram and Company converted into Ram LLP. It is converted Ram LLP. There are two partners, Ram and Shyam, and the obligation and the rights of Ram and Shyam are same. Means there is no change due to such conversion. Means there is no change due to the conversion. Means the right and the obligations are same. Means there is no change. Means when it is a partnership firm, then the right and obligation are same. Means the obligation, and when it is converted into the LLP, there is no change in the right and obligation, and there is any no transfer of capital assets. So in this case, it will not consider as a transfer. It will not consider as transfer, and section 45 will not be applicable. But there are changes. Means there are some changes. So in this situation, it will be treated as transfer. It will be treated as transfer, and provision of provision of section 45 will be applicable. The section of 45 will be applicable. Means section 45 will be applicable. If there is any change in the right and in the obligation of the obligation and the right of Mr. Ram and Mr. Shyam changed are not same and there is a and there is the transfer of a capital assets. There is the transfer of a capital asset. So in this condition, it will be considered as transfer, and the provision of section 45 means the provision of charging section of capital gain will be applicable. It will be applicable. So if there is any no change, then it will not be considered as transfer. But if there is any changes in the right and the obligation, then it will be considered as transfer. Now we will discuss another compensation on compulsory acquisition. Compensation on the compulsory acquisition. We will discuss this point and the other point or the other section in our next part, in our next class. Kindly consider or kindly understand or revise the previous provisions so that you can properly understand all the provision of capital gain properly. So thank you so much to attend such class, and we will discuss our other point in our next class. Kindly consider next video also. Thank you so much. Bye bye.